When a company like FICO holds an earnings call, the prepared remarks are one thing, but the real story, that almost always comes out in the Q&A. That's when Wall Street analysts get to ask the tough questions, and you really get a peek behind the curtain at the strategy, the pressures, and the future of that little number that rules our financial lives, the credit score. And that's exactly what we're going to break down today. So what's really on their minds? Well, it turns out it's a whole lot. We're talking about a massive shakeup in the mortgage industry, a real battle of the credit scores, and FICO's incredibly bold plan to charge more for their product. This isn't just about some numbers on a spreadsheet. This is an inside look at the strategy that shapes your ability to get a loan.
All right, first up, the single biggest change to FICO's mortgage business in something like 30 years. For decades, the path a FICO score took to get to a mortgage lender was this one, very established one-way street. Well, FICO is basically tearing up that old road and building a brand new superhighway. What they're doing is rolling out what they call a new direct-to-market license program. Now, the official line is that this is all to drive competition and transparency. But if we look at what's actually happening, this move is a huge shift in the power dynamics of the mortgage world. It creates a direct line from FICO to the lenders.
And the key players in this new system, they're called tri-merge resellers. You can think of them as the companies that already do the work of packaging up all the data for lenders. So now, FICO is basically empowering them to become a main distribution channel for the FICO score itself.
Okay, so this slide really breaks it down perfectly. The old way, right? FICO would license its secret sauce, the algorithm, to the three big credit bureaus, and we were kind of the gatekeepers. The new way, FICO is essentially giving that recipe directly to these tri-merge resellers, letting them calculate and deliver the score, cutting out the middleman, all in the name of a more efficient system. And here is where it gets really crucial for the lenders. They now have a choice to make. They can either play it safe with the traditional model, paying about $10 for every single score they pull, or they can take a shot on this new performance model. The upfront fee is way lower, just under $5. But there's a catch. They get hit with a funding fee if the loan actually closes. So for a lender, it's a real strategic bet. Do you pay more for certainty, or do you bet on your own ability to close deals and save a ton of money?
Now, this whole new business model, it's not happening in a vacuum. Nope. It's all part of a much bigger fight over which credit score is going to become the new gold standard for mortgages. So let's take a look at the contenders in this fight. But first, you gotta know who the referees are in this game. You've got the FHFA, the Federal Housing Finance Agency, and they're the regulator for the mortgage giants, Fannie Mae and Freddie Mac. Those are the GSEs. And because Fannie and Freddie back most of the mortgages in the US, they're the ones who decide which credit scores get to be used. So in this war, getting their approval is the ultimate prize.
Okay, now this is where it gets really spicy. This slide shows FICO's direct attack on its main rival, VantageScore. And FICO's coming out swinging. They're claiming their new 10T model is a total knockout, saying it can spot 18% more potential defaults and could get 5% more mortgages approved without adding any more risk. The message here is loud and clear. They see VantageScore as a lightweight contender. And this quote from CEO Will Lansing, it's really the core of their entire pitch. He's basically saying, look, anybody can get their hands on the data, but we have the magic. He's arguing their competitive edge comes from decades and decades of perfecting their models. It is a direct shot at the competition, a super confident declaration that their algorithm is just plain smarter.
So how does all this connect? You've got the new model, you've got the score wars. Well, it all funnels into one central pillar of FICO's whole strategy. This belief that their score is massively, massively undervalued.
This is it. This is the key philosophy that's driving their entire business. The CEO comes right out and says there is a very large value gap. In simple terms, they think they're underpriced. And their multi-year mission is to methodically close that value gap, which is basically Wall Street speak for, we're going to raise our prices. Of course, they were really quick to tell analysts that this wasn't going to be some sudden price shock. No. Their plan is to raise prices predictably and methodically so the industry can absorb it over time. But let's be real. The message is crystal clear. The price you pay for a FICO score is only going in one direction, and that is up. So, with all this bold strategy, how does it translate into their financial forecasts? Well, This is where the story gets really, really interesting. Because what FICO is doing is predicting absolutely massive growth, while at the same time telling Wall Street that they're being extremely cautious. It's a fascinating contradiction. So on one hand, they've built their entire forecast on this foundation of pessimism. They're assuming interest rates won't drop and help out the mortgage market, and they're even bracing for some potential regulatory headwinds. As they put it, they're being extra conservative. And then there's this. This is the paradox. Despite all of that doom and gloom forecasting, they are guiding for a jaw-dropping 28% increase in earnings per share. I mean, let that sink in for a second. After telling everyone how cautious they're being, they drop a number like that. It's just a massive signal of confidence in their strategy. And it's not just on the bottom line either. This is on top of a projected 18% increase in their total revenue. These numbers just show this immense belief that their new mortgage strategy and their pricing power are going to deliver, pretty much regardless of what the broader economy decides to do. Which, of course, brings us to the final, critical question. Can FICO really pull off this incredible high wire act? They are changing their entire business model in their most important market. They're fighting a war to make their new score the industry standard, and they're raising prices on everybody, all at the same time. The potential reward here is massive, for sure, but the risks are just as great. And the outcome of this huge gamble won't just affect FICO, it's going to reshape our entire financial landscape for years to come.